Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome back Eric Wallerstein. He's a fantastic rates researcher at Yardeni. Eric, welcome back to the show.
Thanks, Nick.
Eric is a former repo trader, so we always like to get his insights on the money markets as well and what's going on at the Fed. He used to be over there. But let's first start with the economy, Eric. It's hot. The last time we talked, we canceled our recession watch because there was just so much data pointing to positive growth. So give us an update since then. How are you seeing the US economy?
Yeah, no, I think things look great. No real change overall in how we're seeing things. I think consumption is still very strong and will continue to be, if not, grow stronger. It was very interesting to hear Chair Powell kind of finally come around to the idea that the labor market is in good shape and does look good when, in fact, the Fed basically cut by 100 basis points because they were worried about the labor market. And we had the SOM rule and a number of indicators suggesting a slowdown. But we've been in the camp that things look good, and that's driving consumption. We had Q4 GDP this morning. It was a little bit softer than we had anticipated for a few months. I think there was a big inventory drawdown. There might be some front running of tariffs and kind of reshifting of supply chains, but that's a very volatile component. I think the very important thing was that consumption rose 3.2% on an annualized basis. That's very strong growth. It's sustainable. I think it's based on wage gains. It's based on net wealth gains. And I think things look good. You know, there's a number of question marks heading to what will tariffs do. But I mean, overall, we're still pretty optimistic.
Eric, we hear a lot that the US economy is the stock market and vice versa. How do you characterize that statement? Do you agree with it?
Um, to some degree, I think it's a little wrong to say that the stock market and the economy are totally disjointed, right? Like, what drives a stock market? It's earnings, corporate earnings, and corporate earnings are heavily tied to just U.S. economic growth and global growth. I think a lot of people are worried that there's very high valuations, right? There's a number of kind of growthier names that are doing very well. So stocks are pricey, right? Like it's almost reminiscent of 1999 and 2000 and the dot-com bubble for some. But I think while it's led a number of strategists and shops to say that we expect lower real returns, we don't think risky assets are going to do that well in the coming years. We think, based on stronger than expected economic growth, that earnings are going to be the kind of engine for stocks and risky assets across the board for this year, 2026, and through the end of the decade. I think people spend too much time on valuation, which are famous last words to some degree. But if you think about it, like the S&P 500 is vastly different today than it was at any point in history, right? It's dominated by very large hyperscalers, and these tech companies are trading at high valuations because not only are they high quality, like these are very strong cash flow, strong balance sheet businesses, but also they're growing their earnings very quickly and they have very wide profit margins. So it makes sense to pay a higher multiple for growth that isn't slowing down. And the DeepSeek we called it a gray swan, and it was nice to see that Nassim Taleb actually called it a gray swan as well, as he is the kingpin of black swans. I don't think it's a huge negative. There's a lot of capex coming from Meta, Microsoft, basically every tech company who wants to play in the AI sandbox. If DeepSeek overall just reduces the amount internally, how much it costs for them to add AI to all of their applications, and it reduces their own costs in terms of employees and wages, overall, I mean, some of that AI infrastructure spend probably will continue for cutting edge research. But if you have less spend and you don't need it as much, and you can be more efficient in producing newer products and new applications and newer versions, it's probably a net positive. So, we had the big NVIDIA freak out, but I think overall cheaper AI is a good thing. And it's, something that can probably boost productivity for workers, for companies outside of big tech. And it's one of the reasons why we think that the S&P 493, so cutting out the Mag 7, is actually going to do much better this year and next year, as those companies start to cut costs and benefit from more efficiency and can actually benefit from AI it's really been such a pick and shovels trade thus far with energy providers and chips manufacturers, and now I think the broader economy starts to benefit as well.
As Bitcoin's role in the global financial landscape evolves, understanding its potential impact on your wealth becomes increasingly crucial. Whether we see a measured adoption or accelerated hyper-Bitcoinization, being prepared for various scenarios can make the difference between merely participating and truly optimizing your position. This is why Unchained developed the Bitcoin Calculator, a sophisticated modeling tool that helps you visualize and prepare for multiple Bitcoin futures. Beyond traditional retirement planning, it offers deep insight into how different adoption scenarios could transform your wealth trajectory. What sets this tool apart is that it's integrated with Unchained IRA, the only solution that combines the tax advantages of a retirement account with self-custody of Bitcoin. In any future state, maintaining control of your Bitcoin keys remains fundamental to your Bitcoin strategy. Explore your potential futures at unchained.com/TBL. Don't write your seed on paper. It's estimated that so much Bitcoin is lost forever, and the main culprit, the main reason, is poor seed phrase security. This is why we use Stampseed, a DIY kit that enables you to hammer your seed phrases into titanium plates using professional stamping tools. These plates are heat resistant up to 3,000 degrees, fireproof, crush-proof, and time-proof. They're compact and easy to hide, and they can be used in your single sig or multi-sig setups. Make sure you go check them out today at stampseed.com and use code TBL for 15% off of your order. You mentioned that you have a 8,000 target on the S&P over the next few years. My question, you probably answered it a little bit with your comment about earnings, but why aren't stocks pricey here? You mentioned they're going to have growing earnings. We shouldn't be too focused on that pricey component because it's just the valuation, and expensive valuations are warranted, you're saying, because of these high quality names, high quality tech names. Talk about your S&P 500 target over the next few years and why you don't think that today's valuations are expensive. And if you have already answered it in full with your last comment about earnings, that's okay also.
No, I think if let's think about US stocks, they're trading at like a 22, maybe 22 and a half times forward earnings valuation multiple. If we just expect earnings to grow based at their historical average, and we're a little more optimistic, like I said, that's kind of our lean, our bent. If you're expecting 8 to 10% earnings growth, even excluding dividends, you should have like historically average S&P returns, and that's what we expect. I think some of the DeepSeek stuff and a lot of these tech names that are trading, like the Mag 7 trade 30 times forward earnings. They're much more lofty than the overall index. Even if you get some multiple compression there, because let's say AI is a little more hype than we anticipated, or earnings growth does slow, which is possible. Like NVIDIA's profit margin is 55%. Like, can you maintain that? It perhaps, but it could be difficult. So let's say that slows and those companies re-rate a bit. They're still very high quality. So I think there's a lot of drivers into those stocks that aren't just growth. But I think the S&P 493 that are trading 19 times forward earnings, there's some room for them to expand their multiple. I think as people rotate, there's been a lot of gains in the Mag 7. I think as people rotate and those companies start to benefit and you hear it more in earnings calls, I thought one of the most interesting things from a few quarters ago was Accenture was saying that AI was one of their biggest revenue or earnings drivers. Accenture is obviously consulting on how to implement AI for SMEs and for just Fortune 500 companies. Those companies will start to use it, right? And they can potentially like augment their workforce. And people worry about, oh, okay, they're just going to cut costs by firing employees. I mean, we're at full employment. We have a 4.1% unemployment rate. We think the unemployment rate is going to remain low for at least the foreseeable future. So I think it's a huge help for companies that are or have been competing for labor for several years, now can augment that labor and cut costs and be more productive. So even if you get a little re-rating from the big tech companies, I think you get a re-rating up from the S&P 493, and potentially maintain that 22 times forward earnings multiple, and then just see earnings growth power things ahead.
I want to ask you about Bitcoin. Yesterday, Bitcoin popped. It's continuing this morning. There was some Fed rhetoric around inflation and the restrictive nature of where policy rates are today. My big conclusion yesterday, Eric, was that the Fed is a little bit balanced in their outlook, but it's either hold or cut. It's not hike. There's no hike in the equation because they maintained, and Powell doubled down, we are still sufficiently restrictive. So, what's your response there, and how did you look at the Bitcoin price action and other risk price action when he said that?
Yeah, it was interesting when the FOMC minutes came out, 30 minutes before Powell's press conference. I thought it was hawkish. They removed the line about inflation making progress towards 2% and just said inflation remains elevated. I was like, wow, the Hawks have closed the coop. Like this is kind of the Doves saying, all right, putting their hands up and saying, we're on pause for the rest of the year unless something material changes. And then during Powell's press conference, Colby Smith, who's now at the New York Times, asked, "Hey, what did you mean by that sentence?" And he said, "It's actually just to shorten the sentence. Don't read into it." So completely downplaying that kind of hawkish bent. And then he said, in response to another question, that not only are conditions, the economy's doing well, stocks are doing well, whatever, but conditions are still very restrictive, suggesting that, if inflation continues to moderate, the Fed will be cutting more. And Bitcoin, on both of those questions, popped, and it was up 2% after doing nothing basically from 2 to 2:30 or 2:35 p.m. Eastern. So I think it's very interesting. I think what appeared to be hawkishness is actually quite dovish and just a little bit of a hedge from them, just noting that strong growth is kind of prevailing. One kind of quirk, which I've taken interest to, is the inflation gauge that Chair Powell cites in his press conference. Back during the November meeting, which was the second rate cut, but it was 25 basis points following 50. So they had cut by 75 basis points. And Chair Powell said that 3-month and 6-month annualized core PCE, their preferred inflation metric, look much better than the year over year gauge, right? Like inflation is on a sustainable downward trend because the most recent prints are lower. And Governor Chris Waller was also citing 4-month core PCE, which you're starting to just kind of like shake and bake which months you're looking at. And then this time around, Chair Powell said, 12-month core PCE is your best gauge because it cuts out seasonality. What's really interesting is back in November, I thought you're going to get bit in the ass by this because in Q1, price resets happen, right? Like companies raise prices in January and February and March. And it happened last year and happened the year before. And it really caught the Fed off sides last year. So they just are kind of, whether that's the right way to make policy or not, I don't really care. The idea is that Chair Powell and presumably the FOMC are just going to shift the goalposts a little bit to make sure that they can cut the federal funds rate later this year, as long as, everything kind of remains status quo. I think, they raised their expectations for inflation this year, ostensibly because of, tariffs and immigration policy and kind of some uncertainty there. But I think as long as inflation comes under that revision, which it should, then they're good. They're golden. They can cut rates. So I think risky assets, I don't really see the headwinds for risky assets other than maybe less government spending. But even that, I think you don't really want to rely on government spending. And I don't think we need to. I think the consumer is very strong. I think CapEx is very strong. And so I'm optimistic.
What about the idea that they are still restrictive? Can you do you agree with that or not? I mean, stocks are doing incredibly, up about 50% over the last couple of years. The economy is growing at a decent clip. So are they correct, or how do you make sense of that comment looking at the markets?
I think either they're neutral or slightly accommodating right now. I think when they started to cut rates, we were seeing slower growth. We saw payrolls be revised down. Unemployment was starting to rise. Like there were a number of indicators to suggest, hey, maybe long and variable lags are in fact taking place. So I understood the fact that they said, okay, a 5.3% federal funds rate might be too restrictive. Let's cut. it turns out that a lot of those indicators they were looking at were then later revised or proved to not really matter. The SOM rule got reversed. Payroll growth was quite strong in Q4, and we had stickier inflation. So their reason for cutting has already been disproven. So then why did they cut by 100 basis points? Like, they're if the reasoning for being lower 100 basis points is now no longer true, then they're probably a little more accommodative. I think five and a quarter was probably appropriately restrictive, and I think inflation was making good downward progress. There are still some pockets of the economy that are feeling not great, right? Like, there's a lot of people who borrow in the leveraged loan market or from banks or from private credit, and they borrow on a spread over basically the overnight rate or the repo rate. So if you borrowed at SOFR plus 300 basis points when SOFR was like 50 bips, well, now you're basically paying 800 basis points on that. And that's pretty rough for a lot of middle market firms. And I think they're definitely feeling the pinch. And that's why you see all these crazy financings in the private credit market, PIK loans. It looks a little weird and incestual, honestly, but there's definitely a little bit of pain. Manufacturing, I think, was feeling a lot of pain as soon as basically Trump was elected. We thought that would reverse as kind of the optimism returned, right? Like, ahead of a presidential election, there's so much uncertainty, regardless of who it is or who wins, whatever. That uncertainty fades immediately thereafter. But so if you're waiting to hire, you're waiting to invest, now you have the certainty of who's in office, and also you're expecting less regulations, a more accommodative business environment, and potentially a lower corporate tax rate. So manufacturing is probably coming back. I think the ISM PMI, like the national manufacturing gauge, will signal that it's an expansion either January or February. So basically the laggards of the economy are now picking back up, in part because the Fed has cut interest rates by 100 basis points, in part because we have a new kind of regime in Washington. But in either case, the Fed lowered rates too quickly, too much. And if we get stickier inflation and growth continues and we're still at full employment, I think we're going to be looking back 6 months and saying, like, what did we do? You know what I mean? But I don't think they'll hike. I think you're 100% right. I think there might be odds of a hike in the rates futures market. And I think some people will, flash that idea, especially if there's like a wonky inflation print and it comes in a little hot. I think like there's nearly a 0% chance of that happening, as low as to zero as possible, because the inertia of the institution is so strong, and to admit that they made a mistake cutting would be just really bad for their credibility. And I think it's better to just keep rates here, which are not super low, like 4.25%, 4.5%. It's not like a very low federal funds rate. It's probably fine, and we have a little, upward slope in the yield curve, so the long end is a little tighter. I think this is fine for interest rates. They really shouldn't cut more, and I think if they do cut more, it's going to lead to a huge melt up in risky assets, and that's where you get the valuation-led bull market. That's where you kind of get worried that a melt up is going to lead to a meltdown.
So not restrictive, neutral to slightly accommodative is how Eric is characterizing. And I agree with you that they have plenty of cover just where the nominal rate is, because they can say, hey, look, for the last 15 years, this is very restrictive relative to that period. So it gives them cover to just keep it there. And so for our viewers, Eric, what we're watching is, we have our own TBL liquidity metric. It combines the banking system, rates, bond volatility, and the dollar to give us a sense of what are the conditions for risk assets. And it's my opinion that without the potential for a hike, like you said, near 0%, it will keep a lid on bond volatility and keep risk markets supported generally. I know you've been somewhat bullish on treasuries. You think that rates would come down a little bit once they reached 4.5, 4.75. They're back at around 4.5. What's your just overall take on treasuries, yields where they are, and then the move index and volatility from that perspective?
Yeah. I was buying once we got above 4.7% on the 10-year. I was buying the 30-year and then the 7 to 10 after that, and just like kept buying for basically 4 weeks. I think, 4.25 on the low end to 4.75 on the high end, given if you get a little fiscal scare or whatever, probably makes sense. I just think there's more room to the downside for yields. I mean, I think a huge reason of why, like the so-called neutral rate, or where the Fed should hold rates to keep them kind of neutral, is higher, is because we had so much fiscal spending. The government deficit is 6.7% of GDP. That's like a wartime recession level number. It's going to slow. I think this administration is, they'll cut taxes and there will be some accommodative policies that, maybe lower revenues, but I think they're going to cut spending pretty drastically. We're seeing in the first, what is it, 10 days only? Like a lot of actions to rein in the number of federal employees, loans, grants, aid. I think agencies will be shrunk. So, I mean, if you get less fiscal spend, I think real GDP growth will be okay because it's mostly consumers and private investment. 2.5% GDP growth, if it's fueled by that, is perfectly fine. But you don't need as high interest rates, right, if the government isn't pumping the economy with money. So, I mean, what could get us to 5% on the 10-year yield? I don't see a lot. There'd have to be like a really big fiscal issue where they're issuing a ton of bonds. Inflation would have to be very sticky. The Fed would, like, the idea of a hike, I think, would have to come into the fore. And we saw, I think there's a lot of buying power. The 10-year got to 4.8%, and I think there's a lot of real demand for bonds at that level, especially with the rest of the world cutting interest rates. The rest of the developed world, at least. Like advanced foreign economies are broadly dealing with slightly sticky inflation, but horrible growth. The Bank of Canada just ended QT, and they're going to start buying bonds again in March. That's like a real shift, and I think treasuries are, the place for global investors to go. So there's a lot of demand preventing yields from going higher. And what could lead yields to go lower? A growth slowdown, inflation slowdown, Fed cuts if it's believed that they're not like preemptive and they're off sides on that. There's just so many things that could lead to that, to yields falling. And also owning bonds, you're getting the return anyway. I don't own bonds as like a hold. I just trade them because I don't think 4.5% after inflation and taxes is really anything. But I think there is plenty. There could be more room to the downside, and there's a lot of like geopolitical risk out there still. So we'll see. But I'm not really worried about the 5.5%, 6% 10-year yield. I think that's a little crazy. And I think 2023's actions by the Fed and the Treasury, well, it was really all the Treasury, to kind of remove that pressure of so many bonds and notes on the market, is something that the Treasury can just use from now on. You know what I mean? It's a tool. And I think it speaks to the idea that policymakers don't want rates to be too restrictive. Because ultimately, the long end, it is tied to mortgages, business financing, like much more of the U.S. economy and therefore the global economy are tied to the 10-year yield than like the Fed funds rate or SOFR. So that goes too high, and then you're worried about an actual drag on growth and potential like breaking something in the financial system. So I don't know, 4.5% makes sense. Like we have good real GDP growth. We have a little sticky inflation. I think it's fine. I wouldn't own it unless I was like a pension fund or something, but I think it's fine to trade.
And Eric is referring to something that, we've pointed out also, which is that when rates fall, it supports borrowing, and that will stimulate the economy. Now, we know that Trump and his administration, they want a good stock market, they want a good economy. So we have to just strip away all these other factors and try to maybe isolate what will they do to prevent 10 and 30 yields from going up, not issue as much. And so you'll be watching the percentage of bills, as a percentage of the whole treasury landscape as closely as we will, because as long as bills are being issued at a fast clip, it means the long end won't be issued as much as they could have, and that should keep a lid on yields. Would you agree with that?
Yeah, I mean, I think it's a tool. I do think that the economic policy team is inclined to not use that tool because it's not sustainable debt management. But I do think that there will be less need to issue treasuries and there will be some positives on the demand side. So if you cut fiscal spending, right, you have a lower deficit. That's the best way to prevent more bond issuance. I also think the banking sector, which has been under obscene regulations for the last 15 plus years, is going to get some relief in terms of their capital ratios. And it had a huge impact on money market funds, reverse repo, everything. When during the pandemic, they basically allowed banks to hold treasuries and not be penalized for that in terms of their risk ratios. If that's removed and you can just hold as many treasuries as you want, if you're JP Morgan or Bank of America or whoever, I think banks and hedge funds and real money investors will be much more inclined to hold them. Um, I think that this economic policy team is very attentive to the risks of just flooding the market with bills. I mean, it only works for so long, right? At some point, the market says, like, this is too much, right? This is unsustainable. And then you get actual fiscal concerns that raise long term yields because people think spending is out of control. But I do think spending is going to fall. I think you're going to get, yes, lower taxes do decrease government revenues, but you'll get some revenues from tariffs. And I do think they're going to cut a lot of spending. And I mean, like, when you look at the charts of like entitlements, right? Medicare, Medicaid, Social Security, there's such a huge portion of our outlays that it's really hard to imagine just staring at that chart, where do you cut from? But when you actually like get down into the nitty gritty, there's billions of dollars that fly like everywhere all the time. And if you just have like an ethos or a mentality that, hey, we need to be more efficient and more thoughtful about where we spend, then I think you get less government spending. And for the people who are worried that less government spending is going to lead to lower growth, because like it directly and indirectly will feed the economy, you can't also be worried about the deficit, right? And like the amount of debt there is relative to GDP. Something has to give. And I think there's no better time than now to rein in government spending. The economy's in such good shape. Consumers and businesses are not over-levered at all. Like their debt ratios have been falling. I think they can service debt. They can take on more debt. There's plenty of room for more leverage in the private sector. I think this is the best possible time to cut government spending and rein in the deficit. And I really think like this administration and this economic policy team are conscientious and working towards that. So I'm not overly worried if government spending falls. I think there's so much support in from the real economy and from consumers and businesses to kind of keep the engine chugging along, just a different source of fuel.
And when we talk about the propensity for banks to lend in a more deregulated environment and the private sector being more willing to take on additional leverage, the combination of those two things really does underpin a bullish outlook on risk assets. So we agree with you there. I have a few questions on credit extension and more leverage. Basically, you say the private sector has ability to take on more leverage. That means more borrowing. Banks, if they're less regulated, they will be able to participate in that. So my question is, as credit expands, more borrowing, that's going to be more spending and investment, that's going to grow GDP. But what about the dollar? What effect does more lending, more leverage in the dollar system have on the dollar? Does it depend if it's done domestically or not? Does it depend if banks are lending to different parts of the world in USD? Talk about the dollar, and you can bring in tariffs and Trump's policy and all that, and what we're thinking, even interest rate differentials, which you mentioned. ECB and Canada continue to ease.
Yeah, no, and it's honestly a big like gotcha from a lot of economists or people, that like a lot of these policies and just the prevailing economy sound dollar positive, and like the dollar is up a pretty substantial amount over the past few years. Oh, this administration wants a lower dollar, like that's incongruent and doesn't make sense and everyone's stupid. It's like it's very fraught, and I think both Besant and Moran, and Hassett and whoever have a good idea of this. They understand what drives FX, and I think that you kind of get a redux of the Plaza Accord and hopefully not the Louvre Accord that happened 2 years later, where you just kind of negotiate with other countries to crowd in like how do you support your currencies and like ending unfair trade practices abroad is not just a tariff story, because also tariffs are interrelated with FX. You can't just create tariffs and do like one-sided, like, okay, hopefully this fixes the accounting identities of the current account deficit and the financial account. I think you negotiate with other countries. I think Japan is probably going to be one of the first out of the gate. It's easier to negotiate with one country than like all of Europe. And I think they're more interested in that and they want to invest in the US. So I think like you negotiate, okay, like maybe you spend more on government on your own defense. You can add to your reserves and you like, let's say you sell yen, add to reserves, you buy more long-term treasuries, whatever. I think there's ways to negotiate that. And there's plenty of lessons learned from what happened in the mid to late 80s where you don't get an unreasonably sharp appreciation and some of those currencies that depend on weakness, right? Like the yen, Japanese exporters depend on a weak yen. Do they need the yen to be 165 to the dollar? I don't think so. Especially if you get favorable trade terms from the people you're exporting to, right? The US consumer is like the consumer right now, especially with Europe's slowdown. So I think like China's kind of MO right now to get out of this recession or whatever you want to call it, slowdown, is to export their way out. And that's why goods prices in the US have been falling for a year and a half. We've literally had deflation in terms of goods. Even though goods demand is picking back up over the last couple of quarters, they need US consumers more than we need their goods, by and large, outside of maybe some critical minerals, whatever. I think they'd also be interested in figuring out how to make that work for both of them. Like tariffs are a necessity to probably start a conversation, and you do raise some revenues, whatever. But ultimately, you can rebalance trade through those negotiations. So I think while a lot of these things sound dollar up, at least in the near term, I think this administration is very aware of that, and I think they'll use it as a negotiating tool. Like it'll be used to kind of reconfigure global trade because the dollar as a reserve asset is like a blessing and a curse to some degree. But because it is a reserve asset and we are the US, you can use economic statecraft to achieve, a slightly lower dollar and support our own manufacturers and exporters through other means. And I think that's what this administration is looking to do, is use those tools, different kind of versions of soft power, to then make our industries more competitive.
And if you just think about it from the chart perspective and a quantitative perspective, what that means to us is that DXY in the 110 to 115 range is a no-go zone, and it's going to be where they start making those negotiation efforts, soft power, figure out what tool they can use to put a lid on that dollar and prevent it from spilling into global contagion as well as hurting the US and its competitiveness. Would you agree with that?
Yeah. I mean, I think there's plenty of benefits to a very strong dollar and it'll never be overly weak, but it comes at the expense of kind of our internal economy. And it is a lot of the reason why like the Rust Belt is in such dire straits for the last 20, 30 years. Ever since China's entered the World Trade Organization, so many things have gone wrong or stagnated. Like the U.S. workers' share of gross domestic product is lower. You have stagnating industrial production, manufacturing capacity, and capacity utilization completely stagnated. That's 20 plus years of just no growth for those sectors of the economy. And manufacturing, just the narrow definition, is 10% of U.S. employment. There's obviously supplier. There's much. It's a much bigger supply chain than just that. But like that is a very significant part of the population that is losing out due to something that's not really their fault. It's just a configuration of the dollar as a reserve asset. So I think this administration's attentive to it. I think they'll work on it, and I think there might be some volatility, especially this year, first 100 days, right as the market tries to digest what like new policies mean and what change means. But the status quo was just to run government deficits until everyone panicked, right? Like that was never going to work for the long term. It was a perpetual kick the can down the road. So now it's finally taking a step back and saying, okay, how do we fix this? So it might mean more volatility. Maybe not rates fall as much as we've had during the Fed's hiking regime or tightening campaign, but it probably just means broad macro volatility. I don't think that's a bad thing. I think it's natural. And I think ultimately we come out on the other side in a better stance.
I have a few more questions for you before we wrap. Are you watching this Doge calculator on the debt clock tick up? You mentioned lowered government spending, finding efficiencies. Are you actually watching this? How much their savings, and do you give any credence to that actual number? Where are they getting it from? How are you tracking
No,
the reduction in spending?
I'm not watching it. I'm sure they're doing something there, but it is early days, right? It's the first week or two. I think it's more the ethos of, and also the people within the current cabinet, right? Like the heads of agencies, people leading these departments, not relying on more workers and expansion and more grants and more funding. The idea of, we'll see what this like federal worker, pay you 8 months severance, right, to leave, what it actually turns out to be. But I think the idea is just like cut the people down. And I think it's the same thing that Elon did with Twitter or with X. Like, okay, yes, is the site this exact same functionality with the same ad revenue as it was 4 years ago? I guess not, but it definitely still works and people still flock to it. And like, the White House press secretary is on there and government leaders are on there like making statements, right? Like it's still like with what 80% lower workforce, right? Like I think that is what he's bringing to this administration, and there's going to be some hiccups, and we've already seen some like weird things and people worried about where funding is going to come from. I guess they're just quirks that are going to have to be worked out, but the spending has to be cut from somewhere. And you're probably not going to just erase Medicare, Medicaid, and Social Security. That'd be pretty brutal. Defense spending can be more efficient, but like to some degree, it's not going to drop dramatically. That said, we can encourage other companies to spend more on defense, and we can like most of defense spending in other countries comes back to the U.S. into our private sector, right? Like for every dollar we give to Ukraine, how much goes to Lockheed Martin? I don't think that's a hugely negative thing, and I think we can find a way to lower the deficit. But I don't know, like cutting $50 million in scholarships to random people, like I don't know how much of a dent that leaves, but I think the ethos is there, and that's the most important thing. That for the next 4 years, that's going to be what we're attempting to do.
Excellent. Now, I want to ask you quickly about Xi Jinping and Donald Trump. Do you think there's a deal there? Do you think that I'm getting this sense that there's less hostility right off the bat. Do you get that sense? Do you have an expectation there at all?
Yeah, I think that makes sense. I think, and it's not completely just the previous administration, but generally, like there's an antithetical view of China, kind of like this dual hegemon kind of take on the world, which is almost reminiscent of the USSR and the US a few decades ago. I think China's really in dire straits. Their economy is just not working, and I don't know if it's like the will or the want and the lack thereof, but like China is not geared to boost lower and middle class consumption. The consumer in China has done great for the last since Deng Xiaoping because they opened the economy, right? They went from like an agrarian economy to opening to the rest of the world and allowed capitalism in, and they grew, and therefore the lower 50% and the lower 90% were able to benefit greatly. But this is not an economy that funnels wealth down or like boosts, raises up workers, right? It's an economy that sucks money and assets up to the top, and it's super indebted. Like local government vehicles plus the central government actually is not that over indebted. They have like 80% of GDP debt to GDP. I think they should issue more debt at the central level, but like there's this overhang of zero ROI projects in local governments, like growth at all costs. They don't know what to do. They're not willing to give fiscal stimulus to consumers. So they're just exporting at all costs. And like we're the big consumer, you know what I mean? Like Europe is now in a recession because of those exports. They have to send them somewhere. They're going to send them here. Like the demand in Europe is almost evaporated. Like Germany is in a full-on recession. Growth is negative. So I think that they'll be willing to make a deal and we'll be more open to some of the ideas coming from us because I don't think they know how to figure it out. I don't think they have any idea what to do other than to just manufacture more and more and more. Um, so yeah, I think, there could be a deal or whatever, and we'll see how, like, if they stick to whatever we negotiate with them. But I just think that China's in such a rough spot right now. They do need help, and I don't think they can afford a tariff that prevents most of their consumer goods from coming to the U.S. I think it would physically, like it would really hurt their industry. So yeah, I mean, hopefully they're open to it. I think they will be. I think they have reason to be, but we'll see. We'll see how these go.
Art of the deal, as we say, Eric. Thank you so much for joining us today, Eric. We really appreciate you and your insights at the Bitcoin layer, from the Fed to rates to repo, money markets, and the global economy. Please tell people where they can find your fantastic research.
Yeah, if you go to yardeniquicktakes.com, you can, we write daily. Basically, we'll put up a few charts, we'll put some commentary on there, tying in whatever economic data came out, whatever's news and macro with what's going on in stocks, bonds, commodities, crypto, whatever, just how the markets are reacting, and we'll kind of give our spin and our take. So yardeniquicktakes.com, I think, is a great resource. Obviously, I write them. But yeah, I think hopefully it's helpful for the people who are subscribed and to new subscribers as well.
Eric Wallerstein, formerly at the Fed, now with Yardeni Research. Thanks for joining us once again at the Bitcoin layer. We'll catch you guys next time.
Thanks, Nick.